GDP and the stock market are down, and inflation is up. Is it time to panic? So if we're being honest with ourselves, the macroeconomic news has not been the best lately. The stock market is down with many key companies and their stock values plummeting, some by 20%, 30%, 40%. Companies like Netflix. These same companies were at nearly all-time highs just 6 months ago. Meanwhile, inflation has been going through the roof, with prices flying out of control for simple staples and things like housing, automobiles, and other commodities. They're starting to become more and more pricey. This is in turn making people buy less of them, which is causing the soon-to-be recession to get worse. Speaking of the soon-to-be recession, the GDP for the first quarter of this year was unexpectedly negative, marking what many people fear might be the first true economic recession in more than a decade, with many experts thinking that the coronavirus recession was more of a blip and less of a trend. Is this going to be the big one, the recession that firmly puts us in the same place as the 2008 economic meltdown? Maybe. Is it time to panic? Nope. It's never time to panic. Keeping a level head beats panicking every time, especially if you know the tricks and the trades of beating a recession. That is to say, knowing the tricks is the way to prospering even when times are bad, which is exactly what I'm going to talk about in this next video. After introductions, of course. You're watching Finance Squared. I'm your host, Derek West, and on this channel, we talk about all things personal finance, including stocks, bonds, real estate, crypto, and so much more. Drop a comment with your thoughts on all the negative economic news. How are you planning to weather the storm and not just survive, but thrive in tough economic times? We're all dying to know. And be sure to lovingly, tenderly, gently smash that like button for the YouTube algorithm. But when economic times get tough, you need to keep a level head, as they say, to ensure that you can navigate a pathway and not just tread water, but also swim with the sharks. Here are some techniques that can help you do just that, starting with preparation. Weathering recessions starts while the good times are still rolling. When you're in the throes of a recession, well, that's not the best time to check whether or not your financial situation is in the best of order. You want to set yourself up to weather the storm when the sun is still shining. What do I mean with all that esoteric poetic language? Well, to make it concrete, make sure your debt burden is low. When I say that, I mean eliminate most, if not all, of your consumer debt. Investment debt is fine. You know, things for mortgages or rental properties or businesses. But things like car notes, credit cards, personal loans for things like vacations, etc., all those things are just weighing you down. Do your best to eliminate them as fast as possible. If you're worried about doing that, don't fret. There are many methods that can help you get there. For example, the avalanche method, the debt snowball method, or my personal favorite, the Snavalanche method. Snavalanche, what a term. Anyway, that's a combination of those first two methods, debt avalanche and debt snowball. But that is a topic for a separate video entirely. So make sure you're subscribed and post notifications turned on so you catch it when it drops. But not only do you want your debt reduced, you want to make sure you save up a decent emergency fund. Recessions are the primary use cases for emergency funds. So it's important to take the time and effort while the economy is swinging to put away some money for a rainy day. Because you're going to need those funds if you're not going to participate in recessions, which is my next point. And this point is kind of controversial. A lot of folks have sort of strong opinions on this. Let me tell you what my opinion is. You see, if you want to thrive during economic hard times, simply do not participate in recessions. One of the reasons why this is controversial is that a lot of folks think that it's simply not possible to not participate in a recession. Because by definition, recessions are economic events that affect entire economies. So everybody, no matter how hard they try, is going to participate in a recession, right? How can you not participate in a recession when it can affect an entire state or country or even the globe? Well, of course, economic recessions mean that less economic activity is happening all around you, all around your state, all around your country, even all around the world. So generally speaking, it's going to have an effect on you. What I mean when I say don't participate in recessions is just don't get in on the fun. That's another esoteric sort of statement. What do I mean by that? Clearly, economic recessions aren't fun. What I mean is, in sort of a sardonic way, is that you have to start with your mindset and let that affect your actions and decisions. That's what's going to influence your reality, not the other way around. You see, economic events and trends, both positive and negative, they do indeed affect everybody. And they affect everybody in different ways. There's going to be different opportunities. More than likely, there's going to be less opportunities, at least for a while. But don't let that start to affect your goals and your plans. You'll have to take different routes, try different things, be prepared to take drastic steps, maybe even delay, for a time, some of your best plans. But nevertheless, keep moving forward. A more concrete and real manifestation of this advice is to not get on any kind of public assistance if you can help it. Now, this is not a claim that public assistance is not a good thing in general. Some people are going to need it and not see any way out, and that's okay. That's what it's there for. But you should know that there's always a way out, even when you don't see it right away. And an unfortunate effect of public assistance is that it puts blinders on you, keeping you from scoping out all of the avenues that could possibly lead you to a more bright future. So let me be clear, public assistance is not a bad thing, but public assistance can affect the momentum that you're trying to build. You should only resort to that sort of stuff if it's an absolute last option when you're getting close to starvation. Next up, you're going to want to study bear market tactics. Maintaining your momentum is key, but you also need some techniques and tactics on how to survive and thrive when markets are starting to tank. So bear markets are typically when a market drops in value by 20% or more. Although you will hear a varying opinion on that, that's generally the rule of thumb. But you can tell that you're in a bear market when there's negative pessimism in the air, which causes negative sentiment to further entrench itself. And with that in mind, there are some basic techniques and advanced techniques to know and execute when this happens. Well, first things first, don't sell. Keep your dime in hands, particularly if you have most of your money in a broad-based index fund or ETF. Timing the market to sell your stocks during a recession is fraught with danger. Obviously, if you're selling in these tough times, when everyone else is, the market's already on its way down. And you're basically just racing the clock to see if you can get out before it goes all the way to the bottom. Sort of a wild and wacky game of musical chairs. And if you try and buy back at the bottom, it's even worse, because you usually wait for a little bit and you wait for the dead cat bounce and all that other jargon and jazz. And by that time, the market's probably already going back up. But you're just telling yourself it'll fall back down eventually. And it typically doesn't. And now you've bought high and you've sold low, which is the ultimate investing anti-pattern. If you had just kept investing at regular intervals into your 401k during a bear market, which can last anywhere from 6 months or multiple years, eventually, when the market turns around, when the bear turns into a bull. So just have dime in hands and don't sell, even if you're holding individual stocks. Now, if you're holding individual stocks, hopefully you did your research on the fundamentals of the stock before you purchased it. And hopefully you're doing your research even now to evaluate if this is a good stock to hold long term. If the fundamentals are sound and everyone else is panic selling, then just simply sack up and buy some more shares during times of market downturns. That way, when it goes back up, your holdings will be worth even more. There are definitely some advanced techniques that are slightly riskier and require a lot of investing experience to pull off to profit during a bear market. Things like buying and selling puts, purchasing commodities such as gold, silver, copper, lumber, dollar cost averaging, value investing, etc. They really deserve their own video, which I will of course be releasing soon. Make sure you're subscribed. But this particular bout of market malaise is different than 2008, but it's not unique. This period of time is much like the 70s, except without the disco balls and leisure suits. If your finances are going to be fine, you're going to need to understand what inflation is and how it affects certain markets. Inflation is a concept that very few people truly understand and can predict. But one thing is for certain. If you know how it affects certain asset classes, you can profit handsomely. A general rule of thumb is when money is cheap, goods are expensive. And when money is expensive, goods are cheap. A common example is gold. When interest rates are low, gold tends to be very expensive. When interest rates go higher, gold tends to be cheaper. Why? Because people would rather hold cash than heavy metals. It's more convenient, it's easier to store, and you can get your hands on it more readily than gold or other precious metals. Another good rule of thumb is to keep in mind that inflation is generally good for real estate and stocks. So if you have investments in one or both, then generally speaking, continue to hold on to them long term, as they likely will become very profitable for you no matter what happens immediately in the market. Drop a comment down below with ways you are preparing for a possible recession in the next couple of months. Are you prioritizing saving your emergency fund, getting rid of debt, trying to get into assets that appreciate during inflation spikes? Let us know in the comments down below. And be sure to like this video if you like this video, and leave a comment if I missed anything or was unclear at any point. We definitely appreciate any and all feedback that you can make. Also, be sure to share this video with your friends who are financially savvy, and even the ones who just don't have a clue. And of course, subscribe and turn on post notifications so you're in the mix when our next video goes live. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. I'll see you guys in the next video. Peace.